Good evening, everyone, and welcome to NGEN Markets training session for today. And I am, so we will start with this session as other peoples are also joining. And I hope my screen is visible to everyone and my voice is audible. If I'm not, please, write us on the chat, or please, you can verbally state that up as well. So, in this today's session, we are gonna run through some several topics. One is value at risk. So, how do we calculate historical value at risk and implied value at risk? And we will talk about capture ratios, up captures and down captures for specific funds and also for portfolios as well. And then we are going to run through some drawdowns analysis and comparative drawdowns analysis between the portfolios as well, and how you can use the drawdowns analysis altogether. So these are all risk parameters. One of them, capture ratios, is also a return parameter as well. So we have added and clubbed this entire topics in one single session today. And then we are going to have a Q&A session where you can hopefully answer all those, hopefully question us, and we will hopefully answer those, queries and questions. Either you can write it on chat, or either you can directly verbally state that up. That will be okay for us. So I hope my screen is visible. If it is not, please do write me on the chat. I will definitely, look into it. So I'm just, opening my another portal as well. So let me just give me a moment. Yeah, so as you can see, this is the NGEN Markets platform I've opened up. So we are going to talk about value at risk first. So before talking about value at risk, let me load some fund. So let's load Access Midcap, as you can see. So here, as you can see, the value at risk, whenever we look at risk, we normally see annual, volatility or standard deviation. And standard deviation just basically means that the distance between the mean of any data set of any particular fund or a portfolio or even a stock. So, gauging standard deviation and, looking into the volatility, because the risk and the returns are all being added into the volatility altogether. So that's why, considering value at risk is more appropriate, because it talks about the downside risk of the entire fund. So let's go ahead and let's see, what is value at risk and how do we calculate value at risk within historical and implied here as well. So as you can see here, we have given two bases of the value at risk. One is a historical value at risk, and another is a implied value at risk. So, before going into ahead, what we are going to do is we are going to download this price series. So as you can see, this is downloaded. And we are going to open up our Excel so that I can show you how the calculations are going on for value at risk. So I hope my Excel screen is visible to everyone. Please write me on the chat box and I will definitely, look into this. So here, as you can see, we are going to just look into this returns. Let me just, remove this up. Yeah. So here in the returns, we are going to highlight this as green so that we can recognize this, when we calculate the value at risk. So first, what we are going to do is we are going to do one basis of historical value at risk. So historical, and we are going to calculate another one as implied. So what does this both things means? We are going to just, calculate that as well within this two parameters. Now for that, first we are going to look into confidence interval. So I'm just going to write this confidence interval. And normally we take confidence interval as 95%. So this is our confidence interval, and we are going to calculate the percentage change. As you can see, this is percentage change. So this is going to be 100 minus our confidence interval. So we are going to just take into account 100% minus our confidence interval. So that's going to be the 5% percentage change. So this is basically probability as well. Whenever we look into the percentage change, we normally say this as probability. So this is going to be our probability for the next calculations, what we are going to do. Now for historical, we normally calculate via daily historical return. We take the percentile of the historical. So how we are going to do it is, I'm just going to type this as daily return, and it is historical. So basically we are going to take it as percentile. So for percentile, Let me just take this. Yeah. So for percentile, all we have to do here is we are gonna, make this formula up is equals to percentile of this particular data set, and we are gonna choose our array. So our array is actually the daily return given here. So all we have to do here is we are gonna take this, daily return into the account, and we are gonna take into the probability. So that is how the daily return percentile is calculated, as you can see. Now, we are going to calculate the annualize. So as you remember, we are actually calculating annualize historical value at risk, annual historical value at risk. So for that, I'm just going to type this at annual VAR, which is historical. So here you can see this is historical annual value at risk. What we are going to do is we are going to analyze this entire data set. So all we have to do here is equals to this multiplied by square root of 260. So 260 is considered as 1 year at NGEN. We normally consider 260, which is like a working period in a year. And when you hit it, you will get certain number. Now here, this is our historical annual value at risk. Now this is based on the daily return, historical daily return of the entire data set. So what does that mean? It means that there is a 5% probability that this particular fund, which is Access Mid Cap Fund, can have a drawdown of negative 22.97%. So this is what it means. Now let's go for implied as well. For implied, I'm just going to copy this up to save our time. And there are certain changes in implied. Instead of taking daily return, we take into account standard deviation, and we calculate implied value at risk. That's how. So how do we calculate that? All we have to do is 95% as a confidence interval given here. Similar thing as before. And here you can see the percentage change. So the percentage change will be similar to the above. So all we have to do is 100% minus the confidence interval we have taken here, which is 5% altogether. And then we are going to take into account standard deviation. So for standard deviation, all we have to do is we are going to take the standard deviation of this data set of the return, daily return. Let me just give me a moment. Standard deviation of this particular data set here. And then we are going to multiply by norm sine phi, which is actually the standard normal cumulative distribution. It inverses the entire thing. It is like a bell curve which inverses the entire thing. And we are going to take into account our probability. So what is our probability? This is the 5% probability which we have taken. So when you take into this account, this is what we get in the numbering format. Now, what is our annualized VAR for implied? All we have to do is we have to multiply this entire thing with the square root of 260, which is 1 year period. So all you have to do here is you have to check this. You have to multiply this with square root of 260. And then we have the historical, we have the implied value at risk given here in this particular format. Let's make this red to give it a a drawdown scenario. Now here, as you can see, I'm just going to color code this to actually highlight this up for implied and historical, so that you can clearly see these are the different color codes for implied and historical. So what does that mean here? The difference between these two methodologies are only the thing that when we calculate historical value at risk, we take into account for the daily return percentile, which is given here. And when you check in the formula given here, which is the percentile of the daily return of this particular probability which we have taken. Similarly, when you go for an implied one, we take into account for standard deviation. So standard deviation of this entire data set with the inverse of the normality of our entire returns. So here we get the implied value at risk. So now what does this entire thing implies? That there is a 5% probability that this entire fund can have a loss of negative 24.32%. Now, if we want to change the probability, let's check this with our system. Let me just show you the system here. And let's check it accordingly. Give me a moment. So once we check this with our system, you can see here accordingly that the numbers which we have here. Yeah. So here you can see the annual VAR historical is negative 22.97% with a 95% confidence interval. So that's what we mean is that there's a 5% probability that this particular asset can have a negative 22.97. Similarly, for the implied one, which we have given here, is given as negative 24.32. Now you can change the confidence interval and check it out yourself. Let's say we go for a worst to worst loss, a worst case scenario altogether. Let's say we have a scenario which is more worse than COVID, or maybe like American crisis of 2008. So we can definitely change the confidence interval, and that changes it up to negative 40.47. Similarly, you can check this out with 99 given here, and that shows you negative 40.47. And you can even change the confidence interval of implied, and you can check the probability. So whenever you check the confidence interval as 99, the probability is 1%. You just have to negate 99 with 100%, and you get your probability altogether. So that is what the historical and implied value at risk suggest. And this historical and implied, the value at risk, there are several other methods to calculate value at risk, which is like a conditional value at risk. There is a bootstrapping method. There is a normalization of the asset method, which is also called as parametric method, which uses a bell curve. So these are other sets of methods which are quite complicated, but here we have used these two methods to simplify the process for you and to make your clients understand that what you are going into and what is this historical and implied value at risk all about. So that is how the historical and implied value at risk is given here. And I hope my screen is visible to everyone in this two format which I have shown it up to you. So that is what the entire value at risk model is all about. Next, we are going to talk about is that how you're going to compare the value at risk with other multiple funds which we have taken into account. So here, as you can see in the fund section, we can go here into the screener.
Interrupt in between?
Yes, sir.
Can I interrupt and ask you a question?
So we can have the Q&A session directly after this session.
Okay.
Yeah. So here, in the screener, when we actually see the value at risk, all you have to do is, let's say we load in a category, let's say small cap fund. So once we load in the category, you can see here that these are the categories which are loaded. You can filter the AUM as well. Let's give it a AUM as 1,000 minimum 1,000 crore as an AUM. And then when you see all you have to do here is you have to load in a risk parameter. So for loading a risk parameter, all you have to do is you select the risk column. Once we select the risk column, you can see VAR as historical and implied given here. Now, what you can do here is you can sort in the historical VAR accordingly. And this is actually taken defaulted as 95% confidence interval, which we have given before. So for 95% confidence interval, this particular funds are actually having the lowest and the highest VAR. You can accordingly, arrange them in an ascending or a descending order. And similarly for an implied VAR, which we have given here. So that is how this works out. You can do this for multiple categories. You can filter the AMCs, and you can definitely see which are the riskiest fund based on the historical value at risk parameter, and which are the riskiest based on the implied as well. So that is how this works out. And you can also see VAR in category averages. We have given that, this averages out the entire categories. So all we have done here is when you look for an equity asset class, all you have to do is you have to sort in according to the VAR historical and implied. And if you click on this, let's say sectoral pharma, you can see the historical VAR for that particular funds. So that is how this works out for the value at risk. Next, we are going to talk about is capture ratios. So what are capture ratios and how do we use capture ratios all together? So all you have to do is let's load in some fund. Let's say we load in Mirai asset. Let's go ahead and load in some funds from the compare section altogether. So I'm just going to click it in the section here, and you can see the Mirai asset fund is loaded here. And here you can see the fund performance. So before going ahead, all you have to do is you have to check in the benchmark accordingly. And with that particular benchmark, you can see the relative column here. So within the relative column, we have given annual return over benchmark, tracking error, and many such other parameters. And in that parameters, you can see the capture ratios, which is given as up capture ratio and the down capture ratio. So what does up capture ratio signifies? When up capture ratio is more than 100, the fund manager of this particular fund, Mirai Asset, has actually outperformed the benchmark. And outperform in the sense, all you have to do here is you have to click on this I button, and you can see accordingly that the monthly return, the addition of the monthly return, you can see for our asset, which is Mirai Asset, is actually higher than the benchmark. That's why we have outperformed the benchmark accordingly, as you can see, which is more than 100. And for the down capture, all you have to do here is you have to just check I button, and you can see the drill down approach, which shows you that the benchmark has more negative loss, which is negative 33.32, while as our asset is having negative 22.26. So what is the contribution factor for this cumulative outperformance? So this particular fund is actually having both up capture, which is contributing highly in the up market, and both the down capture as well, which is contributing to our outperformance against the benchmark. There are certain cases where some funds are actually not up capturing, not beating the benchmark, but due to the down capture, they are actually outperforming the benchmark. As you can see in this case, Axis Midcap Fund, you can see that there is a cumulative outperformance, annual return over the benchmark is positive. So what does that signifies? As you can see, this is less than 100. This means in the up market, when the market was up, our asset was not performing according to the market. Our market has outperformed our asset. When you click on this I button, you can see our benchmark is 72.22% as a return, and our asset is 61.55. So what does that signifies? It signifies that there is a contributing factor of down capture, which is actually giving our outperformance against the benchmark. So if you click on this I button, you can see that benchmark is negative 44.14, while our assets return is negative 31.38. So the entire outperformance has been due to the down capture ratio. So when the market was down, our asset was performing fairly well against the market. So that's how you can gauge the fund managers' performances against the benchmark. And to keep the note, this is a relative column. So in the relative column, whenever you change the benchmark, whenever you change from BAC, NAC, whatever benchmark you have chosen, the up captures and the down captures are going to change. And there are several platforms altogether. They show you the up capture ratios and the down capture ratios, but they do not show you the drill down approach and how the entire up capture has been calculated. So you can see for some particular months when the benchmark was actually up, let's say for 10.25, our asset was 9.39. So you can see for every single month given here, breakdown till the today's current period. So every single fund, we are going to take another use case. Let's see, we go for another fund, which is Quant FlexiCap. Now for that, if you see the up capture and the down capture, it will show you the, there are, the annual return over benchmark is in negatives. Now, what are the contributing factor? You can see the up capture ratio is close to 100, but not 100. So basically we are underperforming against the benchmark. And similarly for the down capture, it is 99.70. So let's change a benchmark. Let's change to something else. Let's see if we can change it, and we can see that there is some change in the up capture and down capture. As you can see, the down capture is actually more than 100 now. It means we are actually giving the benchmark is actually better than us in losses period. You can see the benchmark is having the lesser loss than our asset altogether. Similarly, for the up capture, all you have to do here is you have to click on this I button, and you can see the comparisons between the asset and the benchmark. So that is how the up captures and the down capture works. The calculation is fairly simple. Whenever you look for an up capture, all you have to do is manager's return upon index return in 200, and you get your up capture ratio. And similarly for the down capture. So this is how this both up capture and the down capture ratio works out. And you can, fairly do it for a portfolio as well. So when you look in for a portfolio, all you have to do is you go into the portfolio section and you load in any portfolio altogether. So let's say I'm loading in standard proposal. So for this portfolio, I can even do a value at risk parameters altogether, the historical and implied, which we have done before, and also the capture ratios. So you can see accordingly that I can change the confidence interval for both of them. and see what are my underlying probability for that particular risk. This is how the risks are. And I can also see what are my up captures and the down captures accordingly. So now this is not about fund manager. This is about us, that, as an advisor, we are choosing certain securities for our client. So how our portfolio is behaving against the benchmark which we have chosen here. So as you can see, this is our asset and this is our benchmark and this is our capture performances. So we are not actually beating the benchmark accordingly for the up capture ratio, and you can see the down capture as well. So given here, we can also discuss about the drawdowns analysis. So for drawdowns analysis, the drawdowns can be actually accessed both via funds and also via portfolio. I'm just going to show you via portfolio directly from here. So all you have to do here is you have to click on drawdowns here. So once you click on drawdowns, you can see the losses, the highest drawdowns given here. So these are the gray area. Let me just zoom in some gray areas. So this is the gray area. It is the biggest loss of 2-year period, as you can see, and you can zoom it in, and you can see this is the loss period altogether, and how many days it took to recover for this particular gray area which is given the loss. So basically, we have given the top 10 drawdowns within the start date and the end date. We have the start price and the end price as well, and you can see that how many days it took to recover for this particular loss. So this loss is negative 32.99%, and the days to recover is 107 days. So you can view it out for every single drawdowns given here, and you can even do it for the entire data set of the funds and even for a stock. Let's explore for funds altogether. Let's see what we can do regarding the drawdowns. One thing here is to how drawdowns are useful is, let's say we consider one fund, like let's say a blue chip fund. So the days to recover might be higher for that blue chip fund. So now what we are going to do here is we are going to keep a cap, like let's say the days to recover might not be more than 120. So when we construct our portfolio, we would construct in such a way that the highest drawdown which we have should be having the days to recover less than 120 or 100. So that can be a risk management technique which you can use regarding the drawdowns which we have given here. So yeah, I'm just going to load in some blue chip fund altogether. And I will show you the drawdowns of that particular fund altogether. So this is how this works out for the drawdowns analysis. You can view it for any single fund, any single stock. We have given it for the stock as well. As you can see, the days to recover for here is actually 165 days compared to our portfolio, which was just 110 or 105 days. And here we have also given the loss which is still ongoing, the drawdown which is still ongoing, and how much it has recovered. So it is 43% recovered as of now. So when you are suggesting a fund or a portfolio, so you should look into those parameters so that you can manage the risk for your client. And there are several other techniques for value at risk as well. One single technique here is that when you look for a value at risk, let's say a 99% VAR. So this is the worst probability. This is the 1% probability that this is the worst drawdown we can have, negative 40.28%. So now when we construct a portfolio, we are going to ensure that it should be less than negative 40.28. Might be 35%, might be negative 20%. Whatever it is, we can ensure our value at risk should not go more beyond than 40%. So that's how we can choose in for different sets of asset and different sets of securities altogether. So this is it for the entire session with value at risk, the capture ratios, and the drawdowns analysis which we have given here. One important thing here is when you compare value at risk with the analytics, please note that whenever you go into the screener, these are taken into account since the inception. So the figures might look different when you open the analytics into the fund section or any portfolio section. So if you make it since inception, the value at risk parameters for historical and implied both will reflect identical here in this format. So that is how this works out. You can onboard that via risk columns, and you can compare value at risk with any single categories given here. So now we have actually completed this entire session. We can start with our Q&A session altogether. Arunab sir is also here, so please shoot your questions on the chat or via verbally, and we would answer that up.
Umir, can I take the first question?
Yes, definitely, sir.
Yeah. See, you were explaining value at risk historical. In the Excel file, you showed 95% confidence interval and then 5% value at risk, something. And 22% was negative for excess mid cap, I suppose, right?
Yes, yes, sir.
So if we take 260 days as 1 year, and 5% of that will be 13 days. So just for a plain interpretation, there will be 13 days when I will be investing into this fund, and there is a probability that I will get an annualized negative returns of 22%. Is it that way I have to interpret?
Actually, hi, this is Arunab. I just like to correct
Hello.
that a little bit. Hello. I
Please.
hope you can hear me. Yeah.
Yes, I can hear you.
So I'd like to correct that a little bit. So, sir, this is not 5% of the 260 days in 1 year. What this is saying is he's saying that 5 times out of 100, which means 5% chance, you have a 5% chance of losing this much money on an annual basis. So obviously, for example, we don't know what is going to happen over the next 12 months. But over the next 12 months, there is a 5% probability that you could be down that much money. So it is not very probable, but if you are very unlucky, you could see that return. So it is in the realm of possibility. So basically, if the future is repeated 100 times, 5 times out of that, 5 times out of 100, you will lose at least this much money. That's what this is saying from a probability perspective. So this is the percentage chance of this happening.
Okay, fair. And what is that implied? That standard deviation implied?
Sir, basically, sir, VaR, value at risk. There are many ways of calculating that. We have just shown 2 here. There are many mathematical models, because as you can see, this is just it's like a probability forecast. It is never going to be 100% accurate. But it is just like, people say, 85%, 90% of smokers will get cancer. Now, I'm sure there are a lot of smokers who don't get cancer. Right? So the point is, this is the best guess, right? But to come up with this guess, there are many different calculation methods. So here we have shown you 2 methods. One is a historical VaR method and the implied VaR. The implied VaR, just for understanding purposes, focuses much more on volatility. The historical VaR focuses just on return only. So the implied VaR, takes volatility into account as well.
Taken. Thank you. Okay, got it. Clear.
Hello, myself Anil Agrawal.
Yes, sir.
आवाज आ रही है?
Yes, sir.
आपने कहा कि appropriate benchmark select करना है, तो हम वो कैसे करेंगे? मतलब एक्चुअली जो बेंचमार्क्स यहाँ पे दिए हुए हैं, वो उसके मतलब कि जो बेंचमार्क यूज कर रहा है, अगर वो यहाँ पे ऑलरेडी नहीं आ रहा है, जो एनएससी में दिया हुआ है, तो उसको हम appropriate benchmark से कैसे कंपेयर करेंगे?
तो यहाँ पे सर आपके कोई अगर कोई बेंचमार्क हैं जो आप एक्सपेक्ट कर रहे हैं कि यहाँ पे हो और यहाँ पे नहीं आ रहे हैं, तो हमें बताइए और फॉलो अप करेंगे उसको ऐड करने के लिए. तो वैसे हमने काफी सारे ऐड करे हैं यहाँ पे.
जैसे मान लीजिए ये जो बेंचमार्क यूज कर रहा है S&P BSE मिड कैप 150 TRI. हेलो
जी. हाँ जी.
तो अब इसमें हम लोग जो एनएससी में देते हैं, तो आप इसमें वो वाला है बेंचमार्क?
तो देखिए यहाँ पे जो TRI वर्जन है वो वाला अभी तक हमारे पास नहीं है. उसका हम इंतजाम कर रहे हैं. हमारे पास रेगुलर वाला बेंचमार्क है जो टोटल रिटर्न नहीं. अगर आप TRI वाले टैब में देखेंगे तो हमारे पास लिमिटेड नंबर ऑफ TRI इंडिसेस हैं. निफ्टी है, निफ्टी 500 है और ये बाकी सेशन. हाँ जी, उसमें है नहीं. तो वो हमारे जैसे हमें डेटा मिलता है हम उनको ऐड करते हैं.
तो हम कैसे इसमें एप्रोप्रिएट क्या है, हम कैसे जानेंगे?
देखिए जैसे अभी हाँ जी. तो यहाँ पे है
आप हमें BSE में दिखाइए. जैसे BSE मिड कैप 150 दिखाइए.
हाँ जी, BSE का मिड कैप इंडेक्स होगा एकदम ऊपर.
वो लिख सकते हैं, मतलब 150 तो नहीं दिख रहा है इसमें.
तो आप BSE का मिड कैप इंडेक्स भी. हाँ जी.
ये ले सकते
नहीं
हैं।
नहीं, यहाँ पे नहीं है,
तो
वो
मतलब
निफ्टी
थोड़ा नियर
एनएससी में
होगा।
150 का इंडेक्स। हाँ जी, हम बीएससी में क्या ले सकते हैं।
ओके ठीक है।
हाँ जी,
और कस्टम में ओके, और
हाँ
कस्टम
जी,
में हम लोग कैसे क्रिएट करते हैं,
हाँ
थोड़ा अलग क्वेश्चन करना चाह रहे हैं, कस्टम में
सर।
कैसे क्रिएट करते हैं?
हाँ जी सर, कस्टम में तो सर पूरा आपको फ्लेक्सिबिलिटी है। कस्टम में बहुत अच्छी चीज है, इसको आप डेफिनेटली यूज
जी
करिए, क्योंकि यहाँ पे आप अपनी तरीके से इंडेक्स को क्रिएट कर सकते हैं। फॉर
हाँ
एग्जाम्पल, अगर आप कहते हैं कि मेरे को 50% लार्ज कैप इंडेक्स चाहिए और 30% मुझे मिड कैप में डालना है और 20% स्मॉल कैप में डालना है, ऐसे मुझे इंडेक्स बनाना है।
जी
तो आप किसी भी तरीके से बेसिकली आप इंडेक्स में परसेंटेज एलोकेशन हैव टू ऐड अप टू 100, ये आपको देखना पड़ेगा। उसके बाद आपका एक कस्टमाइज इंडेक्स बन जाएगा, जिसको आप एक नाम यूज करके उसको सेव कर सकते हैं। और सेव करने के बाद वो हम लोग अपनी तरफ से ऑटोमेटिकली इसको डेली अपडेट करेंगे। एंड साथ में आप जो भी चाहे पोर्टफोलियो या फंड या कुछ भी रन करें, उसको आप अपने सेव जो कस्टम इंडेक्स है उसके साथ रन कर सकते हैं।
हाँ,
तो इससे आपको
हम
यू आर
अभी
नॉट लिमिटेड।
रिसेंटली यूजर है, माई सेल्फ अनिल अग्रवाल फॉर वाराणसी। तो अभी हम एकदम
हाँ जी,
रिसेंटली यूजर है, अभी मैंने ज्यादा नहीं
हाँ जी,
किया है, लेकिन मैंने
हाँ
इसको
जी।
क्रिएट किया, लेकिन वो मेरे सिस्टम में दिख नहीं रहा है। मतलब उसमें था कि 30 सेकंड के वो रिफ्लेक्ट करेगा। तो मैंने
हाँ
फॉर
जी।
एग्जांपल एक सेट किया था, वो अभी तक मुझे मेरे कस्टम में कुछ भी दिख नहीं रहा है एक्चुअली, जबकि मैंने इसी
अच्छा
तरीके से किया था।
अच्छा, इसी तरीके से किया था आपका, वो हो जाना चाहिए था। देखिए यूजुअली अबाउट 30 सेकंड लगता है सेव होने में, लेकिन वो जो लोडर चलता है
जी
वो लोडर चलता रहता है। और अगर आपको कोई
जी
इशू हुई है तो हम अपने सपोर्ट टीम से आपसे कांटेक्ट करा देंगे। अनिरूप और उमेर, इफ यू
अच्छा
देयर प्लीज मेक श्योर समबडी फॉलो अप। वो आपका प्रॉब्लम नहीं होगी, वो हम टेक कर लेंगे। ये काफी लोगों ने बनाए हुए हैं, तो ये डेफिनेटली ढंग
जी।
से चलेंगे।
और
कोई इशू होगा हम
कस्टमाइज पे
देख।
और फर्दर भी जानना चाहेंगे कि और क्या क्या किया जा सकता है, क्योंकि कस्टमाइज अगर कोई चीज होगी तो वो ज्यादा मतलब कि हमारे
जी,
जो पर्पस है उसको
कस्टमाइजेशन
सर्व।
तो आप यहाँ पे, जी हाँ, यहाँ पे कस्टमाइजेशन बहुत अवेलेबल है, नॉट जस्ट इंडिसेस में और
जी
भी हैं। तो अगर आपने रिसेंटली ज्वाइन किया, आपकी ट्रेनिंग एंड ऑल अगर नहीं हुई है,
अभी
तो वो भी
अभी
हम
इन
अरेंज करा
प्रोसेस
देंगे।
है अभी, क्योंकि हमारा मतलब कि उनके साथ में फंड एक्सपर्ट के साथ में अभी चीजें सिंक नहीं हुई हैं, तो अभी हमारी चीजें पेंडिंग है।
ठीक है, वो हम फॉलो अप करेंगे। अनिरुद्ध देर और मैं
Yes, sir.
ओके, वो अच्छा लगा, ये सेशन काफी अच्छा था।
थैंक यू सर, थैंक यू।
Thank you, sir. There is another set of question. It was a question by Mr. Pramod Kadam, direct message. Let me just copy paste that up. Can you help me with adding a security into benchmark? Example, I want gold as a percentage of my custom index. I took NAV of the gold fund and created a security. How do I move forward?
Okay, so here you want to use gold as a benchmark, or you want to use gold as a custom security?
So
I'm guessing
yes,
benchmark.
yeah,
Yeah, can I
so
come in?
yes,
Pramod here.
yeah, Pramod sir,
Yeah,
please verbally state
Yeah,
yourself.
yeah. See, actually, I attended the previous session and we had a discussion on the custom index. And what I'm trying to do is I'm giving around 5 to 6% as a gold in some of my clients' portfolio. Now, for the debt and equity, I am able to create the custom index using, the weightages, like let us say, 55 and, 40 and another 5, I want the gold. Okay. So in the custom index, like what has been shown by Arnab, I have done the two selections. But if I want to bring the third one as a gold, how am I going to do it? And in the last session, I was told I can create a NAV, date and NAV, and it create a custom security first, and then I can use that custom security as part of the benchmark, okay, in the custom benchmark. So the second part I am not able to do it. I successfully created it as a security, but how do I make it as 5% of my portfolio?
Yeah. So, sir, if you've created a security using gold prices, that is fine. Now, as far as the custom benchmark is concerned, that can only be created using price series that are available in as an index or benchmark. So currently, we don't have a series in our benchmark section which represents gold. So when you create a custom security, that is for your own analysis and they can't be used as benchmarks. But if you do want to create a benchmark where gold is a portion of that benchmark. The way we can make that happen is we can include gold in one of the available benchmark indices. So where you see this change benchmark box here, just like we have foreign indices, etc., we can add gold and silver, historical prices. That should not be a big problem. And if that is there, you'll easily be able to create a custom index where gold is a part of that custom index. Right now, this is not available.
Yeah, just one more input. See, if we can have a flexibility to bring some aspect of my securities into the benchmark, it will help. Like, let me tell you another example. There are NRA clients, who have these NRA deposits, which is giving them decent tax-free return. And we want to consider it as a part of my debt. So that, whatever I am recommending will be completely on the equity, but I want to consider that as a part of the debt. So I am able to do it in my securities, but similarly, if we can bring some of them into my benchmark for comparison. See, because if I want to evaluate my overall portfolio, I need to have this proportion into my benchmark. Only then it will be realistic. Hope I'm making my
so
question.
in this case, So we understand. So I think here currently we have a process where you can take the available indices that we have and then use them in different various forms to create a customized index. But what we don't have is the ability for you to supply your index, your benchmark values yourself, right? This is something we'll have to look into. I mean, right now, if you want us to create some indices which represent of FD deposit or something like that, that is possible, but it will be a standard one that everybody has access to. But if you're looking for a place where you can create your own benchmark with your own data, that system is not available currently.
Okay. I think adding on gold and maybe one or two things with a maybe like a deposits or things like that will help to bring in some flexibility in the portfolio benchmark.
That we will do, certainly.
Thank you. And your sessions have been pretty helpful, for us. Thank you.
Thank you, sir.
Thank you so much, sir. Are there any other questions? So there is a direct question from Mr. Pawan Gupta. Have missed the training. Where can I get the recordings of it? So, sir, if you are, if you can hear me out, we are actually rigorously uploading those webinar videos on YouTube. So soon enough, you will be notified, and you can check out our demos and training session here. All you have to do is you have to click on this demos and training, and all the sessions, all the webinars are uploaded here. So, if you want to look into the recorded webinars, they are definitely loaded here into our YouTube channel, and you can definitely view them up. So they get uploaded within 1 or 2 working days. Any other questions from anyone? Okay, fair enough. I believe there are no such questions. If you, so there is another question. Yeah, so if you want, you can please, mail us up on support@engineresearch.com. If you have any queries, any issues regarding the platform, we will be here. All the product team will be here to answer you out. And secondly, we will also rigorously keep doing this webinar sessions and training sessions for every one of you guys. And please do attend, and please, do a question as we are here to answer all those queries for you. So thank you so much. I'm wrapping up this session for now. We are going to meet again next week, Friday, 4 o'clock. And, so happy weekend to every one of you who have attended and taken their time of their weekend for us. So thank you so much, and, have a nice day. So that is, all for this session.